Every investor eventually faces this question. Should you trust a fund manager or trust the market itself? Active funds promise outperformance. Index funds promise simplicity. One tries to beat the market, the other becomes the market. But here's the uncomfortable truth. Most investors never understand the difference. They choose based on brand names, advice from friends, or random social media opinions. And years later, they realize something painful. Higher fees, lower returns, confusing portfolios. Meanwhile, some investors quietly build wealth, not by chasing the best fund, but by understanding the system. Index funds, active funds, two different philosophies, two different outcomes. So the real question is not which fund is popular. The real question is which strategy actually works for long-term investors in India. Today, we break this down step by step, calmly, clearly, so you can decide where your money should go before your next investment decision. Disclaimer right after hook. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Understand what an index fund actually is. An index fund simply copies a market index. For example, the Nifty 50 index. It tracks the top 50 companies in India. Companies like large banks, IT giants, major consumer brands. When you invest in a Nifty index fund, your money automatically spreads across those companies. No stock picking, no predictions, just market participation. Example, if you invest 5,000 rupees every month through SIP into a Nifty 50 index fund, you are essentially investing in India's top companies consistently. Over 15 to 20 years, this simple system can build significant wealth. Low cost, high diversification, minimal decision-making. Step 2. Understand what an active fund tries to do. Active funds have professional fund managers. Their job is to beat the market. They select stocks, they time sectors, they rebalance portfolios actively. Sometimes they succeed, but often they struggle to consistently beat the index. Why? Because markets are extremely competitive. Thousands of analysts, millions of investors. Information moves fast. And one more factor, higher fees. Active funds charge higher expense ratios, which slowly reduces long-term returns. Even a 1% difference in fees can reduce lakhs of rupees over 20 years. Step 3. Understand SIP investing. SIP means Systematic Investment Plan. You invest a fixed amount every month. Example, 10,000 rupees per month. Month after month. Market up, market down. You continue investing. This creates rupee cost averaging. You buy more units when prices fall. You buy fewer units when prices rise. Over time, your average cost stabilizes. This reduces emotional investing and builds long-term discipline. Both index funds and active funds allow SIP investing, but simplicity favors index strategies. Step 4. Asset allocation. Never put everything into one category. Smart investors diversify. Example allocation: 60% equity funds, 20% debt funds, 10% gold, 10% cash or liquid funds. Equity builds growth. Debt stabilizes volatility. Gold protects during uncertainty. Cash provides flexibility. This balance protects portfolios during market cycles. Step 5. Understand market risk cycles.
Markets do not move in straight lines. Bull markets happen, bear markets happen. Sometimes markets fall 20%, sometimes 30%. During these phases, many investors panic. They stop SIPs, they sell at the worst time. But disciplined investors do the opposite. They continue investing because long-term growth happens after corrections.
Step 6. Rebalancing your portfolio. Over time, your allocation changes. If equities rise strongly, your portfolio may become 80% equity. That increases risk. So once a year, you rebalance. Sell a small portion of equity, move it to debt or gold. This keeps your portfolio balanced and reduces volatility. Step 7. Tax awareness. In India, equity mutual funds have capital gains tax. If you sell before 1 year, short-term tax applies, currently around 15%. If you hold longer than 1 year, long-term capital gains tax applies, currently 10% above exemption limits. Understanding taxes helps you plan exits wisely. Long holding periods usually improve efficiency. Step 8. Common investor mistakes. Chasing last year's top fund. Switching funds too frequently. Stopping SIPs during market crashes. Ignoring fees. Over-diversifying with too many funds. And the biggest mistake, expecting quick profits. Wealth building is slow but powerful. Step 9. Scaling your investments. Start small, maybe 3,000 rupees per month. Then increase gradually. 5,000, 10,000, 20,000. Every salary increase your SIP. This strategy is called step-up investing. Over decades, it dramatically increases wealth creation. Step 10. Choose your strategy. Some investors prefer active funds because they believe strong managers can outperform. Others prefer index funds because they trust market efficiency. Many experienced investors combine both, but beginners often benefit from simplicity, low cost, consistency, long-term focus. Smart investors think differently. They do not chase hype. They build systems, month by month, year by year. Index funds, active funds, both are tools, but discipline decides outcomes. Stay consistent, stay patient, stay rational. One day, your future self will look back and quietly thank you for choosing strategy over emotion.